Hey everyone, and welcome to our deep dive today. We're going to be looking at something pretty fascinating happening in the world of big tech, specifically Amazon, Google, and Microsoft.
Right.
These companies are making huge investments in AI infrastructure, like seriously, huge But here's the thing. Even though they're making record profits, this massive spending is actually kind of scaring some investors. Why is that?
We see that all comes down to CapEx.
Capex.
Yeah, which stands for capital expenditures.
Okay.
And it's basically the money a company spends on things like buildings equipment.
Uh-huh.
And in this case, all that computing power needed for AI.
Right.
CapEx is important because it shows you where a company is putting its money and what its plans are for the future.
So it's like peeking into their strategy playbook.
Exactly.
Yeah.
Now, usually when companies see a lot of demand for their products or services, they invest in CapEx to meet that demand.
Makes sense.
And investors are usually happy.
Yeah.
But this time, something unusual happened. Amazon, Google, and Microsoft all announced they're going to spend a lot more on AI infrastructure.
Okay.
Amazon is projected to hit a mind-blowing $108 billion in 2025.
Oh,
Google's right behind them with a massive $75 billion.
wow.
And Microsoft's also upping their spending, though maybe a bit more cautiously.
Okay.
And guess what? The stock market didn't love it.
Really? So even though these companies are doing well, the news of these big investments actually made their stock prices go down.
Yep. All three of them saw their stock prices dip after the announcements. Microsoft even lost all the gains it had made that year.
Ouch.
Yeah, it was not good.
Okay, yes, surprising. So why the sudden panic? Help me understand what's making investors so nervous about this.
Well, one of the main reasons is that these big CapEx investments impact something called free cash flow.
Free cash flow.
Yeah, which is a really important metric for investors.
Yep.
Imagine you have $100 and you decide to spend $30 on a new piece of equipment for your business.
Yeah.
You still have money, but you have less to play with right now,
Yeah.
right? That's kind of what's happening with these companies. They're spending so much on AI infrastructure that their free cash flow is taking a hit, at least in the short term.
So is it just that investors hate seeing money being spent, even if it's for something that could be really important down the road?
It's not just about hating to see money spent.
Okay.
It's about how investors value companies. Free cash flow is one of the key things they look at to figure out if a company is healthy and if it's a good investment. When free cash flow goes down, some investors get nervous because it can make the company look less valuable in the short term.
Gotcha. Can you give us an example of how this is actually playing out with these tech giants?
Sure. Take Amazon, for instance. Their free cash flow is now projected to be around $50 billion because of these big AI investments. That's way lower than the $70 billion that was previously estimated.
Wow.
And while Google's free cash flow is currently holding steady at around $70 billion,
Okay.
that massive $75 billion spending plan is putting some pressure on it. Investors are essentially worried that these big AI bets could hurt profits in the near future.
So basically they're missing the forest for the trees.
That's one way to put it.
Yeah.
See, this situation actually reminds me of something that happened during the gold rush.
Oh, yeah.
Remember how the people who sold the picks and shovels often made more money than the prospectors who were actually digging for gold?
Ah, the classic pick and shovel play.
Exactly. And that's what these tech giants are doing right now.
So they're betting on the AI revolution itself, regardless of who comes out on top in specific areas.
Yeah. They're building the infrastructure, the picks and shovels, of the AI gold rush.
Okay.
No matter which specific AI applications or companies become the big winners, these companies are in a great position to profit. They're providing the cloud infrastructure, the AI platforms, the essential tools that everyone else needs to get in on the action.
But are they right to make such a big gamble?
That's the million-dollar question. But here's the thing. The executives at these companies seem incredibly confident about these investments. They're all saying that the demand for AI is skyrocketing, and they can't keep up with the need for computing power.
Wow.
They're basically saying, we have to spend this money to stay ahead of the game, and this is just the beginning.
It's easy to see why they're so bullish. It feels like there's a new AI breakthrough every other week. But can these massive investments really pay off in the long run? And what does this mean for you if you're thinking about investing in these companies? Well, stay tuned because we'll be diving deeper into those questions after a quick break.
Welcome back to our deep dive, everyone.
So we've got these companies pouring tons of money into AI infrastructure.
Yeah.
But is it all just about profits?
Well, it's definitely about profits, but it's also about something bigger, I think.
Okay. What do you mean?
You've used the phrase arms race a couple of times.
I have.
What do you mean by that?
Well, it just feels like these companies are in this intense competition to be the leader in AI.
Yeah, exactly.
And it makes me wonder, are they being responsible? Are they thinking about the potential downsides of this technology?
That's a really important question.
Yeah.
Because the decisions these companies make about how they develop and deploy AI will have a huge impact on society.
Right. Like, we've already seen concerns about bias in algorithms, the potential for misuse,
Definitely.
and the impact on jobs.
Absolutely. And those issues are only going to become more important as AI gets more powerful.
So it's not just about building the infrastructure, it's about shaping the future of AI itself.
Exactly.
And that's a pretty big responsibility.
It is. And that's why I use the term arms race. These companies are competing fiercely to be the dominant force in AI, and the stakes are incredibly high.
Okay, so how does AI fit into the profitability picture?
Well, even without AI, cloud computing is a massive business with fantastic profit margins.
Like, how much are we talking?
We're talking 20, 30% or more.
Whoa.
That means for every $100 these companies make from cloud services, they keep $20 to $30 in profit. That's pretty impressive.
It is.
And the beauty of AI is that it can boost those margins even higher because AI allows these companies to offer specialized services that customers are willing to pay a premium for.
Okay, give me some examples.
Think about sophisticated data analytics, personalized recommendations, or even AI-powered tools for drug discovery.
Right.
These are high-value services that can command higher prices, driving profits up even further.
So AI is like the secret sauce that supercharges their already successful cloud businesses.
Exactly. But it's not just about higher prices.
What else?
AI also helps these companies become more efficient and scale their operations more effectively.
Okay.
They can automate tasks, optimize resources, and make better predictions, which ultimately saves them money and boosts their bottom line.
So even though these companies are spending a lot on AI infrastructure,
Right.
the potential return on investment seems pretty significant.
It does. And there's another factor that makes this even more compelling.
What's that?
The power of network effects.
Network effects.
Yeah. The more customers these companies get, the more data they have, which allows them to create better AI models, which then attracts even more customers.
It's like a snowball effect. The bigger they get, the faster they grow.
Precisely. One analyst even said, and I quote, "Hosting the world's IT infrastructure is one of the greatest business models ever. The upfront costs are steep, but the payoff is generational."
So it's a long game, but potentially a very, very lucrative one.
It is.
Okay, so we've got these companies betting big on AI, convinced that it's the key to their future growth.
Right.
But before we get into whether or not you should be investing in these companies, let's take a quick detour and look at a couple of seemingly unrelated companies that popped up in our research.
Okay.
Expedia and Uber. What's the connection here?
That's a great question. At first glance, they might seem completely separate from the AI world we've been discussing.
Yeah, they do.
But they actually offer some interesting parallels and insights.
Okay, I'm intrigued.
Expedia, for example, just reported an 18% jump in earnings.
So travel is back in a big way.
It is. And it's not just a temporary blip. It points to a resurgence in the travel industry, particularly for major players like Expedia and Booking Holdings, which dominates the European market.
Okay.
They're leveraging technology to optimize their platforms, personalize recommendations, and streamline the travel experience. And guess what? These are all areas where AI is playing a growing role.
So even though Expedia isn't an AI company,
Right.
they're benefiting from the same trends driving the AI revolution.
Yeah. The increasing use of data technology and personalization.
And what about Uber?
Well, Uber is another great example. They're not directly involved in developing AI, but their entire business model is built on data algorithms and network effects.
Right. Uber's platform relies on AI to match riders with drivers, optimize routes, and set prices.
Exactly. It's all happening behind the scenes, but it's essential to their success.
And it's interesting, Bill Ackman, a very influential hedge fund manager, just invested a massive amount of money in Uber.
You did.
He's calling it one of the best managed companies and believes it's undervalued by the market.
That's a huge vote of confidence from a guy who knows a thing or two about making money.
It is.
And it highlights a key point.
What's that?
Uber, with its millions of daily trips and growing profitability, is a prime example of a company that's leveraging scale and network effects to dominate its market, just like the hyperscalers in the cloud space.
So what can we learn from these examples?
I think the takeaway here is that even companies that aren't directly involved in developing AI can still benefit immensely from the trends driving its growth. Whether it's increased travel ride-hailing or countless other services,
Right.
the underlying theme is the same.
Okay.
It's all about leveraging data technology and scale to create more efficient, personalized, and ultimately more profitable businesses. And that's where the hyperscalers, with their massive investments in AI infrastructure, come into play.
Mm-hmm.
They're the ones providing the platforms and tools that are enabling this transformation across industries.
So it's like they're the rising tide that lifts all boats.
That's a great way to put it.
Hmm.
And that brings us back to the question that's probably on your mind.
The big one. Are these companies worth investing in?
Exactly.
Right.
We've seen the market react negatively to their big AI spending plans.
Right.
But is that fear justified?
Or is this actually a buying opportunity?
Let's dig into that next.
All right, so we're back and ready to tackle the big question. Are these companies worth investing in?
Yeah, that's the million-dollar question, isn't it? And like with most things in investing, the answer isn't always simple.
Right.
It depends on your individual risk tolerance, your investment timeline, your overall financial goals.
Of course.
But let's break down some of the key factors to consider,
Okay, sounds good.
starting with valuation.
Valuation. All right, so when we're talking valuation, what are we actually looking at? How do we know if a company is undervalued or not?
Good question. There are a lot of different ways to value a company,
Right.
but one common approach is to look at its price-to-earnings ratio,
Price to earnings?
or PE ratio for short.
Okay.
This basically tells you how much investors are willing to pay for every dollar of earnings the company generates.
So a higher PE ratio means investors are more optimistic about the company's future growth potential.
Exactly. Now let's take a look at Amazon.
Okay.
Some analysts believe its fair value is around $260 per share,
$260.
which is significantly higher than where it's currently trading.
That's a pretty big gap. What's their reasoning for that valuation?
Well, even at that price, Amazon would only be trading at 29 times its projected earnings for 2025.
Hmm.
And when you consider their dominance in e-commerce, their rapidly growing logistics network, and their huge potential in AI,
Yeah.
that seems pretty reasonable, especially compared to other high-growth tech companies.
So they're saying Amazon might actually be a bargain right now, even with all this spending on AI.
It's certainly a possibility worth considering. Now let's move on to Google.
Google,
Some models suggest it's currently undervalued by as much as 20%.
20%. Wow, that's pretty significant for a company of its size and influence. What's driving that potential undervaluation?
Well, Google offers a rare combination of growth and margin expansion. Their core businesses like search and advertising are still growing at a healthy clip. And their cloud and AI ventures are adding new revenue streams with even higher profit margins.
I see.
It's a winning formula for investors looking for both growth and profitability.
Makes sense. So we've got Amazon potentially undervalued and Google offering a compelling mix of growth and profitability. What about Microsoft? They're already a giant in the tech world. Is there still room for them to grow?
Absolutely.
Right.
While Microsoft stock is a bit pricier compared to Amazon and Google,
Yeah.
they remain a key player in both cloud computing and AI. They've got a deep foothold in the enterprise world, which gives them a huge advantage.
Right.
And their CEO, Satya Nadella, has been incredibly successful in transforming the company into a cloud-first powerhouse.
So for investors who believe in the long-term potential of AI, all three of these companies seem to offer some interesting opportunities, even with the market's current jitters.
That's right. Remember, investing is all about balancing risk and reward. These companies are making big bets on AI. And there's always a chance those bets won't pay off as expected.
True.
But if you believe in the transformative power of AI and you're willing to take a long-term perspective, this could be a chance to get in on the ground floor of a technological revolution.
It's like that old saying, fortune favors the bold.
Exactly. And the executives at these companies certainly seem to believe that fortune favors those who invest in AI. Remember what Andy Jassy, Amazon's CEO, said?
I don't think I do.
He said, shareholders will be happy medium to long term that we're pursuing this AI opportunity. He's essentially saying, trust us, this is the right move, even if it causes some short-term pain.
So what's the bottom line here? What should listeners take away from all of this?
I think the key takeaway is this. If you believe that AI is going to be a major driving force in the future, if you think it's going to transform industries and create enormous value, then investing in the companies that are building the foundation of that future might be a smart move.
It's like we talked about earlier. They're not just selling picks and shovels. They're building the entire infrastructure of the AI gold rush.
Exactly.
And whether you're a seasoned investor or just starting out, that's something worth thinking about.
Absolutely. It's a fascinating time to be following the tech world,
It really is.
and AI is at the forefront of that excitement. The decisions these companies are making today will shape the technological landscape for years to come,
For sure.
and it's going to be incredibly interesting to see how it all plays out.
Well, thanks for joining us for this deep dive into the world of big tech and their bold bets on AI. It's a complex topic with a lot of moving parts.
Definitely.
But hopefully we've given you some food for thought and helped you understand the potential opportunities and risks involved.
And remember, this is just the beginning of the conversation.
Right.
The world of AI is constantly evolving, and we'll be here to guide you through it every step of the way.
Looking forward to it.
Until next time, keep exploring, keep learning, and keep diving deep.
See.